Hi, my name is Keith Hall and I'm a CPA. I specialize in working with small businesses just like you. We spend a lot of time working on tax forms, filling in information from last year. Maybe too late to do much about it, but I want to talk to you about some creative ways of actually keeping more of your money, sending less to the IRS. So my tax tip number 3 is encouraging you to look at things a little bit differently related to your medical expenses. Okay, unfortunately, we all have medical expenses. We have medical insurance premiums, our health insurance premiums. Now, those are kind of taken care of for us because as a small business owner, they're deductible right on page 1 of your 1040. But what about the other medical expenses we have? What about deductibles and co-pays, eyeglasses, dentists and doctor bills, prescription drugs that are co-pay? What about braces for the kids? All of those things are not included on page 1 of 1040. You may know that those go on the very top of Schedule A, itemized deductions. The bad news is they're limited. Only the amount that is over 7.5% of your adjusted gross income ever gets deductible. Most of us don't get any benefit for the cost of those braces or our eyeglasses because they get limited. Most of it ends up being zero. Now, what if we could find some place on our tax return to move that money off of Schedule A to some other place where it will be deductible? Now, that could save us some tax dollars. So here's what I want you to think about. I want you to think about a health reimbursement arrangement, or HRA plan. Now, these are authorized under IRS Code Section 105. Now, the only reason I mention the code section, not to make you fall asleep, but your accountant or your tax guy may not be aware of how this can help you. But here's what HRA 105 plans, how they work. Okay, a company adopts a health reimbursement arrangement for the benefit of their employees. These are available because Congress has recognized that not all businesses can afford a big Blue Cross Blue Shield plan for all their employees, or an Aetna plan. So these plans allow for the employees to go out and spend their own stuff. They pay for their own doctor visits, their own health insurance. The company then reimburses the employee under the health reimbursement arrangement, okay? Now, here's what happens. All of those reimbursements, the check the company cuts back to the employee, are not taxable income. They don't go on the employee's tax return anywhere, but they're fully deductible for the business. Okay, now you may be saying, how does this affect me? I'm just a small business person. I don't have any employees. Well, here's the idea. I want you to consider hiring your spouse. Now, don't go out and get married for this because you might not be ahead of the game. But if you have a spouse, they probably already help in the business. They help with your accounting, they help with your marketing, they do mailings, they help with your schedule. They already do something. What I want you to do is make that relationship formal. Actually make them a bona fide employee. Develop a job description, do time cards even, pay them a check every week, do the payroll tax returns, all of the things that you would normally do for an employee. Okay, now your new business has an employee. Now go out as a company and adopt a health reimbursement arrangement. You now have an HRA 105 plan for your business. Okay, here's what happens. Your employee goes out and incurs some medical costs. Your employee writes checks for health insurance premiums, or eyeglasses, or braces for the kids. All of these things that you're already paying for. Now your new employee comes to their boss, you, now be careful making your spouse call you the boss because you might get in trouble there, but your spouse comes to their boss with the receipts and you reimburse them. Those reimbursements are not taxable income to the employee, to your spouse, but those expenses are fully deductible right on line 14 of your Schedule C. This is giant, okay? Now what you've done is you've taken those expenses that used to show up on your Schedule A, remember the top part of that Schedule A that ended up being zero because of that limit, now all show up on Schedule C, right on line 14. These are deductible not just for federal income tax purposes, but also SE tax purposes. That can be 40% savings or more. Now, the average cost for a family of 4 of those type of expenses, non-health insurance premiums, is about $7,200. 40% savings on $7,200 is almost $3,000 in lower taxes just for having one of these plans. This is giant. If you have a spouse that helps you in your business and you have medical expenses right on Schedule A, you've got to get one of these plans. This is huge. Now, what do you have to do to have one of these plans? Only 2 requirements. The plan must be in writing and it must be non-discriminatory. The non-discriminatory part just means you've got other employees, they've got to be covered as well. This can be a great benefit for them as well. The other one, a little more difficult, the plan must be in writing. Now, as you might guess, the IRS wants to see a bunch of paper. You're going to need a plan document, a summary plan description, an adoption agreement, employee notification form, all of these type of forms. But you don't have to worry about creating those. Go out to the internet, search on HRA or Health Reimbursement Arrangement, and you'll get a list of 10 or 20 companies that'll do this for you. Most of them charge about $125 or $150, has all the paperwork ready to go. It's a bargain to spend $150 for $3,000 of tax savings. But again, don't take a shortcut. Don't pretend. Don't just move the money off of Schedule A onto Schedule C. Make sure you have the plan in writing. Hire your spouse. Do the paperwork. The real cost of this $3,000 in lower taxes is doing a little bit of paperwork. Now that sounds like the IRS, but don't just pretend. So at the end of the day, you've hired your spouse, you keep track of the records, you reimburse those expenses, and when it's time to do that tax return next April 15th, you're going to pay $3,000 less in tax. Guys, this is huge. If this fits your circumstances, you gotta have an HRA 105. So this is my tax tip number 3. Hire your spouse, adopt an HRA 105, and when it's time to do that tax return, you're gonna keep $3,000 more of your money. Thanks for watching. Don't forget to check out the links above and the links below for more detail. Also, make sure to rate, comment, and subscribe. If there's something else you would like to see, just let us know. Email us at request@mahalodotcom.